Well, good morning, everyone. Welcome to the Business Owner Strategy Forum, and it's a great welcome to everybody. We've obviously been doing this for a number of weeks now. We're up to week 6 of the forum, so obviously we've been able to provide lots of information and content and sharing over the last 6 weeks, and today is no exception. So as most of you know, we created the forum predominantly to be able to connect, share, support, strategize and implement for business owners in this difficult time that we're all facing at the moment. And that's predominantly why we put this together. I'm your host, Matt Murphy. Most of you guys know me. I'm the Managing Director of Prime Accounting and Business Advisory, and so pretty much spend most of my life helping business owners achieve the reasons why they went into business in the first place and navigate through the complexity of business. And that's predominantly why we exist for our business owners and for our businesses and for our clients. So welcome once again. Today we have got a bit more on the government stimulus. We had some announcements yesterday, legislation passed on some of the JobKeeper alternative income tests, which we'll probably cover a little bit later in the session. We usually start with that. Reason being is that it's only very new yesterday. It's a bit complex, and we're navigating through that at the moment. So we'll probably have some questions around that towards later. But I thought we'd change the pace a little bit today and have a different speaker to talk about the sort of the economy, the market, property market. So we've got Jonathan Bayes, who's the Chief Investment Officer at Prime, who is going to speak to us today around sort of what's going on in the markets, which obviously we're all individuals as well as business owners and running businesses. So it's good to understand that sort of from a personal point of view, but also from an economic perspective around sort of, how that's going to impact upon our businesses moving forward, and so some of the trends and the data that he's seen in terms of what's going on in the marketplace. And we'll also hear from one of our clients, David Justice, who's the Managing Director of Ambience Lighting. And, probably just as a case study and a story around sort of some of the things that they've been doing in their business, which I thought was worthwhile highlighting. And we're going to do that more often over the coming weeks, is to sort of share stories, because that helps us sort of, be part of the community and understand exactly how we can, help each other and get some information from real life situations about what people are doing. And I thought it would be great to share that sort of type stuff as well. So we'll have David present as well. But so without further ado, I'll get into the session. So I'm going to hand control over to Jonathan Bayes, who, as I said, is our Chief Investment Officer at Prime and spends all of his life looking at markets and economic data and the like. So he's got a presentation today that will take us through all of his observations, and no doubt he's been a very busy boy as of late trying to decipher everything that's going on in the markets. So thank you, Jono, for joining us today. I'm looking forward to hearing what you've got to say.
Good on you, Matty. So let me just share the screen with everybody, and we will get going from there. It's always easier said than done, isn't it? Okay. Presentation. There we go. That's all good, Matt. You can see that?
Yes, I can see that, mate.
Okay. Well, again, thanks for having me on. I'll try and keep it short and sharp. I think everybody's probably a bit sick of reading about the virus and a variety of different interpretations on it. So I'll try and spare you a little bit in that regard and really just go through, fortunately, actually, some of the early economic impacts that we've seen coming through in the data, which really have just started to be released this last week or two, and give you a bit of an idea for what we've seen, but also to, I guess, just from a general business sense, how we think it will likely play out. Hopefully I can get that done in 15 minutes or not further, not much longer than that. Again, everything in this presentation, usual story, is general advice, not to be taken for necessarily for your individual situation. I'll jump straight on in, guys. So from where we stand, it's still desperately uncertain in terms of the virus itself. So my 30 seconds only on this, and I've spent the better part of the last 6 weeks on Twitter reading papers and the like, so I'm by no means an expert. Armchair expert even would be a stretch. But doing the job that I do, invariably it takes you down different rabbit holes to try and understand what's going on in terms of issues affecting the market. So I've done a bit of reading, and I think the thing that I come away with is that there is just a desperate uncertainty insofar as the mortality rate from the virus, how many of us have got it, whether or not it's likely to react to a vaccine. And as a result, the conclusion I come to is that this is going to be something that affects our lives for quite some time. I think governments largely around the world have taken the view that this is a virulent, highly contagious virus. It does have terrible consequences in a certain small part of the population when you catch it. And because we don't have a vaccine for it yet, or in fact even a treatment for severe cases, a successful treatment for severe cases, we need to control it. And so that's why we've had the shelter in place policies around the world, and that's why I think in many respects we'll see a continuation of that over the next six months or so. As you've sort of seen there, from what I can ascertain, vaccines, there's talk, they've even started, it's all over the papers today, this Oxford trial, the lady there, really successful in her field, Dr. Sarah Gilbert at Oxford, saying that she thinks she can get a vaccine done with 80% certainty by September. That's hugely optimistic. Ordinarily you've probably seen vaccines taking decades to be sufficiently produced. So there's a huge amount of uncertainty as to when we might see mass manufacturing of a successful vaccine. But I've got to think it's at the very most optimistic by 2021. And then, again, all these debates about, how many of us have had it? Will we get them? Is there any immunity for those that have already had it? That's still highly debatable. And as a result, as I say, we are likely to see some time before we return to what we would deem to be normality. And that's the extent of my, I could go into greater details, but that's the really simple conclusion that I've taken from the virus. And much more important is how we take that conclusion for investment markets and indeed for the economy, which I guess is probably what you guys are most interested in. Just rounding out the virus again, just to confirm how little we know about things. 340, 50, 60 million people in the United States, and as of last night, we've only tested 4.5 million. Again, I'm happy to send this presentation to anyone, but this data is all available on the internet. But again, it just highlights just how little we know about the virus. And again, it's largely those people that have got symptoms that are going in and getting the testing, but only 4.5 million. And below this, it's not included in this chart. The potentially concerning countries are the emerging markets. If you go down 5 from the bottom there, Brazil, they've only tested 300,000 people. India have tested only 20,000 people, incredibly. So the concern obviously is that we know very little about it in developed markets, but we know even less about it in emerging markets. Morgan Stanley gave us a timeline about a week ago on things. Even in the space of a week, these things are starting to look a little bit out of date. Obviously, here in Australia, we've done an incredibly good job, I think, in terms of suppressing the virus. And as a result, New South Wales schools in a fortnight will be starting back a day a week, and I think Victorian schools are probably likely to follow suit. I've told my kids that, it's amazing how keen they are to get back to school, but I've told my kids that there's a good chance in 2 or 3 weeks that they might do a day a week back in school, and depending upon the success or failure of that, it will progressively expand. But again, one of the really big positives that I keep coming back to in all the presentations I've done in the last month on this is that it's pretty terrific to be an Australian in a relative sense. But again, I can, rather than dwell on these things, I can send this through to anyone who wants the presentation later. So the damage that's been done. This number came out yesterday. This is the March Westpac Australian Leading indicator. It just takes a whole amalgam of economic data out and gives us an idea for where the economy is going on a 6-month forward basis. The significance of this chart is just to show you that the leading indicator is saying things are worse than it was at the time of the GFC. I don't think that's a particularly obvious statement. I'll come through a few reasons why. What you'll find in the charts that I show you here, guys, is that there is a real distinction between how the United States is viewing the coronavirus and its impact and how the rest of the world are. And there is a far greater level of optimism in the United States that this is just a passing flu than it is in the rest of the world. And I think that there's some conclusions that can be drawn from that as well. So anyway, so that's the leading indicator. This is the consumer confidence numbers, also by Westpac. This was out on either Wednesday this week or Wednesday last week. But again, you can just see consumer confidence there back at the levels akin to what we saw in the GFC. Business confidence numbers in Australia as well. This is from the NAB. These are all diffusion, not all diffusion indices, but they are indices compiled by the banks. This one, business confidence, Capex expenditure, expectations on the left, and then just the broader business confidence numbers on the right. Again, businesses far more pessimistic than even at any point in time through the GFC, and I'll explain why that's the reason here. There's precious little stimulus levers in Australia to pull relative to what the government had at the time of the GFC, and so I'm not expecting a rapid rebound out of this situation here in Australia, unfortunately. Australian Industry Group data, some of which you guys might even contribute to. That's really good stuff. These are diffusion indices, which many of you might remember from statistics. 50 is break even month on month. Anything above 50 indicates a better month, and anything below 50 indicates a worse month on the previous month. So the services sector is about 80–85% of the Australian economy. You can see there that it's fallen away on the left-hand side in terms of new orders. And on the right, the sales numbers obviously have declined significantly in services as well. The next couple of charts are quite interesting because, unsurprisingly, services has been very weak. Construction is weak, has been very weak in the lead up to this, and dare I say it, I think this is the thing that's really going to kill the construction industry, I feel, for the next 12 or 18 months. We had a lot of respite in the last 6 or 9 months as the banks started lending again post the Royal Commission. We had that cash crunch about 18 months or so ago, and house prices came off, and really within the space of a year we pretty much recouped the high point in terms of national house prices. But I do think that this is going to have a very material impact on demand for Australian housing in the next 12 or 18 months. And that's likely, I think, unfortunately, to have quite a dire impact on the construction sector here locally, which is a shame because it's a really large employer in Australia. It's the third largest sector for employment, behind the retail sector, which has obviously been decimated, and also behind health and aged care services. So that index, again, 6 or 7 year low, but was very weak in the lead into it. The positive is the manufacturing sector. And unsurprisingly, there's been a rebound back. So the two sectors I would say that have done really kind of well over the last month or 6 weeks are manufacturing, and that's local food manufacturing in many respects, but also to local medical equipment sort of stuff in very small way. But that's replacing supply chains that have stopped from offshore markets. So again, a good bounce back in manufacturing, but the other sector obviously has done very well as transport, and a lot of that's to do with online shopping. These are the month-on-month falls in skilled vacancies in Australia, and the reason I pulled this up was just to show you the cascade in job losses that we saw through the GFC and how we're now starting to shape in a similar fashion. So skilled vacancies were very soft in the lead up to the coronavirus, and now obviously that's escalating, which is a concern. And unfortunately, I think we've got some, really at least 6 to 12 months at the very least of softness on the employment side. And that's kind of concerning in a variety of different ways for economic growth. And again, the big thing that is very obvious to say, but we keep coming back to over and over again, is just the cash flow impost that this is having on households, on corporate balance sheets, and ultimately what it will have on the government balance sheet as well. And what it means too for equity markets and for corporate profitability is very simple, and that it's just lower margins, lower return on equity. Balance sheets are going to be far less efficient than they were in the past because we're looking for resilience or dependability in our balance sheet and our cash flows. And as I say, as a result, we're going to see lower returns for equity holders across businesses, be it listed or unlisted businesses. So again, wages. On the left there, you've got construction index wages, which have been pretty good the last few years, still positive at 54 month on month, but definitely the trend is on the downtick there. And I think over the next 6 months, as building approvals struggle, that those numbers will dip negative. And understandably, the wages index for the service sector has plummeted deep into negative on the right-hand side as well. Again, pretty intuitive stuff. Concerns, again, just the amount of leverage that there is in the system. Now, I could pull up any of 8 or 9 or 10 different charts showing you how much debt there is in the world right now, be it at a sovereign level in many different countries, or at a personal and household level, which is really the feature in Australia, or at a big listed corporate level in the United States in particular. But the point of the matter is, post the GFC, we've tried to cure cure the excess capacity, if you will, that was born out of the GFC by throwing more debt at the system and getting people to lever themselves up. And that's why increasingly we're coming to the end of the rope in terms of how we can stimulate by providing people with cheap debt anymore, because most of us have got enough of it. So this is household debt to income in Australia, which has obviously spiraled significantly higher. It's quite the opposite in the United States. The debt is actually held at a company level and increasingly at the government level. Post the GFC, US consumers actually got the message. They were really burnt in the housing collapse there, and as a result, they de-geared the household balance sheet, but it was quite the opposite here in Australia. So I think that one issue for housing is that clearly with more people out of work, there's going to be less demand for housing, but equally too, with the knock-on effects of rent deferrals and the like, I think that a huge proportion of household stock in Australia is held by investors. I think that there'll be a net to sell from investors as well over the next 12 months, and it just means that house prices, as I say, have got 10 to 15% likely downside in them. Again, another consequence of the shock to cash flows will be that we all get more nervous, and more defensive, back to that point about resilience, and it means that the savings ratio at this point in time is likely to start escalating. And you can see there back in the GFC, and we didn't even have a major recession in the GFC, but the savings rate doubled. And I would expect that will be the case again here in Australia and around the world. When we get threatened, the old defences kick in, and we don't want the risk of it occurring again. And particularly in this instance, given it's a virus and we know so little about it, and the potential is for it to come back again. Next season, until such time as we've got a vaccine, I think that there's going to be a huge amount of conservatism from people and businesses, and as a result, savings rates are going to go up. The last one's just a chart that I come back to and have come back to quite a lot in the last couple of years about house prices and clearance rates. I think the red and the white charts are pretty tightly correlated. Hopefully you'll agree with me there. The red line is auction clearance rates, which you can see at last weekend at 39%. It's the lowest it's been in 10 years. Contrast that with 6 months ago when we were back up in the 70s. It leads house prices as a general rule, and I would fully expect that, having seen house prices virtually retain the high point they achieved back in 2017-18, that we will indeed see house prices back in the order of 10 to 15% over the next 12 months. So these are just a couple of the quick points that I would raise that make things different from the GFC. And when I say that we don't have the levers to pull in the manner that we did last time around, back then cash rates were 7.5% or 7.25%, and they fell significantly. We're now at 0.25%. We had a net cash surplus in the Howard Costello years that Rudd and Swan were able to spend. We don't have that anymore. We've got net debt to GDP of 20%, and that's quickly rising to 30% over the next couple of years, given the fiscal and monetary stimulus that has been offered. Household debt to income, as per the chart I showed you before, significantly higher. And the other big one that I think is really important is the Aussie dollar was significantly higher than where it is now. And that gave us a huge amount of ballast in terms of redirecting a lot of business that was previously done offshore back into the local economy. And that's really, people talk about the Aussie dollar and the importance of it for exports. It's really not at all the case. It's actually about import substitution. The big thing that we want the currency low for is actually to make people provide the goods and services here domestically cheaper than it is offshore. And unfortunately, we don't have that lever. And I would dare say that there's actually a risk that the currency in Australia might even push a little bit higher over the next couple of months, because in a relative sense, I think this country is going to do a lot better in terms of protecting itself from the virus than perhaps countries in Europe and the United States. Obviously, the other issue too is that post the GFC, the Chinese economy re-stimulated hugely. And that meant that there was a huge amount of demand for Australian raw materials. I think that we will see that coming through here in Australia, but it will be to far less an extent than that which we saw back in 2008-9. In terms of the impact on this on the rest of the world, China was very early into it. They did a terrific job in stopping it, or we won't go into their allowance of it to hit the rest of the world. But certainly once it was identified in China, they've done an incredible job in terms of testing and tracking. So what we initially saw, and this is the Chinese electricity output, because the Chinese official figures are very open to interpretation. There's a couple of indices that most people look at in China which can't be manipulated. This is industrial output of electricity, which is hard to manipulate that as a number, because once you can't store electricity really. It down 4.5%, which is the worst rate of growth we've seen in 4 or 5 years. I'd expect that is a bottoming out, and we will see that rebound back to positive year-on-year growth either this month or next. In large part because China's sort of back at work. I don't know that they want to be back at work, and I'll explain that in a minute, but they are back at work. And you can see here consumer confidence back above 50, which means that month on month in April, this number was out yesterday from Standard & Chartered, is back up April on March. But you can see the significant fall away that we got back in February in particular. But behaviours have changed in China. And this is what shows you that. And you can get this data out on the web. This is from TomTom. This is literally just car traffic data up until yesterday in Beijing. The red line is the amount of traffic congestion that we got compared to the dotted line, which is last year. And you can see, literally, in Beijing, we're pretty much back to where we were last year, which is great, except for those two notably lower mountains back on Saturday and Sunday. And that is clearly showing you that, yes, the Chinese are back at work in Beijing during the week, but they aren't going out on the weekend. And that, again, is a result of the command economy there. I think in many large respects, and I'm generalising, the Chinese have been told it's back to work time. In fact, I'm told that the government are even putting money in people's Alipay accounts in China, but it's only money that they can spend physically in store. So they're really trying to get things back up and running, but there is a distrust clearly from the consumers that everything's back to normal there, despite the very thorough tracking and tracing that they've got running there. And then you've got the United States. And this is consumer confidence in the US. Now, if you cast your mind back 10 or 15 slides to what I was showing you about Australia, what you saw 2 slides back on China and the smashing in consumer confidence, I'd argue that consumer confidence in the US, which is really only at a 3-year low, is actually holding in there pretty well. It's come off the highs, but when you consider that in the last 5 weeks, we've had 25 million Americans sign on for the dole for the first time in their life, which is just about 15% of the workforce, I would argue that that is still a reasonably confident society and economy in terms of that pullback. Literally, that pullback is back to where US consumer confidence was before President Trump got elected. So I think there's still a healthy optimism, a glass half full attitude in the United States relative to what we've seen in other parts of the world. And you can see it in these 2 charts. The left-hand chart is the Philadelphia Federal Reserve Business Outlook Survey, which, like everything else I've showed you before, has plummeted to GFC or worse than GFC levels. But on the right-hand side, that same index is asking them how they feel about the world in 6 months. Barely even changed. So there really is an attitude in the United States that this is a very short-term phenomena. It's just the flu. And they will come out the other side of this. And I actually think that that's a real risk. And this is a fascinating thing. This is now 2 weeks old, but this was a survey done in the United States. And again, I won't dwell on the chart too much, but the bottom bar charts are the most interesting ones. And you can see there that workers under the age of 45, 60% of all people surveyed either expected that they would lose hours, have already been put on furlough, or lost their job. It's quite extraordinary. And so, as I say, it's fascinating that there is still a belief that the way that they're going to come out the other side of this a lot quicker and with a lot less damage than the real data seems to indicate in the very near term. So this is a quote that a former colleague of mine made about a fortnight ago, and I've basically stolen it from him. He's an infinitely cleverer guy than I am. And again, as with all clever people, they have an ability to describe tricky subjects with simplicity. And he said to me that the world is going to learn that the equity value of resilience is a lot less than the equity value of efficiency. And what he's simply saying there is that for the better part of the last decade, by virtue of cheap debt, we've been encouraged to leverage up. We've been encouraged to make our businesses as efficient for equity holders as we possibly can, using cheap debt, running with less equity. That's manifested itself in the United States with really significant share buyback activity. You can see it now with the debates that are going on at the moment about bailing out Virgin, bailing out airlines around the world, bailing out private equity companies who've all run really efficient balance sheets until such time as we got a glitch in the matrix and now they've all got their hands out. Around the world now, because of this uncertainty, there is going to be a shift back towards a resilience, be that a higher savings rate in our household balance sheets, be that in terms of loan-to-value ratios on property leverage, be it corporate balance sheets, you name it. And obviously, as we all know, when you run with a fatter balance sheet, your return on equity is less than what it previously was. And ultimately, that just means that corporate profitability, as I say, is less.
John, I know that you love to talk about this stuff, and no doubt you could go on for days and months and lots of stuff. But I'm just conscious of time. But I think that's a bit of a great overview of sort of from that overriding perspective. You also run a forum every fortnight as well, is similar to this one, for Prime, for sort of more on the wealth side of the fence. So we'll obviously promote the details of that to everybody as well, so they can probably get further detail. But these slides we'll be sharing, no doubt. Jono will be available for some questions at the end of the presentations today as well. But if you've got sort of a last sort of message that you'd like to leave with the business owners.
No, I think your timing's perfect, Matty, actually. And I just looked at the clock, and I want to apologise for going 5 minutes or so longer. I apologise. And no, I mean, that's really it. Maybe I'll leave it for questions as and when everyone's got it, and let you guys continue on.
Okay, thanks, Jono. That's really good. Appreciate that. That's a good overview. And, obviously we hear and see lots of different things in the market, and it's good to get somebody who's an expert like Jono who can decipher a lot of that stuff and look for trends to see what's going to happen and predict the future, because that's obviously what we're all trying to do as best as we possibly can, because really at the moment we're in uncertain times, and really look for data to see how we could actually, one, leverage on that, two, sort of make decisions, and three, look for opportunities in our business as well. And I suppose that leads me on to the next speaker that we've got, which is one of our clients that we've worked with for many years, who have done some work with personally over the period of time, and just thought it was good to sort of get the voice of a business owner as well going through that, given that we're all business owners on this forum, and just to talk about sort of the period that Dave's had in his business, and some of the decisions he's made, some of the things that have worked and haven't worked so much. So I'm just going to unmute David and share his, you might need to just share your video there, Dave. There you go. So hopefully everyone can hear Dave.
Hi.
Welcome.
Hello. Yep.
Thanks, Dave. As I said, Dave's the Managing Director of Ambience Lighting, which is, I'll get Dave to sort of introduce what their business is all about. But, I've worked closely with Dave over the last, probably 10 years or so, and sort of, worked through this tricky time at the moment. And just thought it was worthwhile, Dave sharing some of his stories as to how that they've handled the business, some of the pivoting that they've done to success, some of the pain they've had to go through. Just to highlight, that we're all in this together, and hopefully we can learn from each other from these conversations. So Dave, maybe just a quick sort of background on Ambience and
yeah, sure. I'll give you some context to our situation. So we're a family business that was started by my father in 1987. So we're based out of Bundoora. We have a 3,000 square metre manufacturing facility and assembly. We have 31 staff. We import a lot of parts from China and Europe, and then assemble and manufacture here in Australia for distribution in the hospitality and retail sector, which is obviously heavily hit by this. So at the start of COVID-19, we sort of projected roughly sort of a 60 to 70% drop in revenue, but it's actually turned out more to be about 80 to 90%. So for example, April, we projected, budget time that we're going to do 900,000 worth of sales, and we're going to do about 100 grand worth of sales. So a significant drop in revenue. Obviously, when this started, there was, a lot of concern, and there's a lot to protect in terms of, I suppose, the company and its people. But adding another layer of complexity to that, which I'm sure a lot of the people on this forum also have family businesses. So that was another layer of complexity in the fact that, you've got your people here to protect, but a lot of our family rely on Ambience as well to generate income for them. So that's another thing that, really need to take into concern, the anxiety within the family on top of the business. So it was quite broad. And my father in particular, who started the business, was quite anxious because he's retired now. And he can't really have a meaningful impact in terms of hands-on sort of help. So he's been quite anxious, and he relies a lot on me doing the right thing in Ambience for him to obviously have a good life. So he's been quite anxious as well. So another layer of complexity to it was we're in the middle of a restructure as well. So as Matt knows, he was helping us with our relaunching our values and our why and how, mission and vision and all that sort of thing. We're doing a restructure of the sales department and a culture review at the time this all dropped. So it was bad timing, put it that way.
Well, good timing, because I think you've got some significant benefits out of going through that particular process as well. So,
yeah,
which is
definitely
part of it. But Yeah, it's good background, Dave. I'd probably like you to, share some of the experience that you've actually had to deal with that complexity, as you spoke about over the last sort of 6 or 7 weeks.
Yeah, sure. I suppose when this first happened, I remember it was probably, I lost track of time, but a couple of months ago, before, people started self-isolating and working from home, it was probably a week before that all happened, and we knew this was going to be a serious thing. I remember it was on a Friday, I think, that I heard that Telstra were going to start, trialling working from home the next Wednesday, and I thought this is big. So I didn't really make any decisions on the spot. I was anxious, but I went home that Friday night and, had a couple of glasses of wine and just thought, what am I going to do here, And I just made time the next day to come into the office when there was no one here and write a bit of a overarching plan. Well, not even a plan, I suppose goals about how I'm going to deal with this situation. So obviously I didn't know what was going to come. So I couldn't write a plan, but it was just some overarching principles or goals that I thought we're going to, attitude we're going to tackle this with. And the main thing I sort of thought of straight away is that, one person's crisis is another's opportunity. So I thought no matter what happens, we need to grow stronger from this and turn it into an opportunity. So some of the, opportunities obviously we're going to be, hopefully if we can, through the end of this, get a stronger team, get more rapport and goodwill within our team and take more market share, because I didn't want to waste the crisis at the same time. That I knew we're in the middle of some significant changes in the business, and we just had a lot of growth and some scaling issues and hangovers from that. And I thought, I'm not going to waste the crisis too. It's a good chance to do some housekeeping as well and get probably some departments back on track as well. So actually a good example of that is probably that just today I've had a new person starting key accounts in a business development role. So his first day was today, and it's probably something you wouldn't expect to hire, especially if you look at our balance sheet at the moment. Some people, conservative, might say, why are you hiring someone now? But I look at this again, don't waste the crisis. When am I going to have a chance? The guy who I've hired is, got a lot of good contacts, is highly talented. I would never be in a position where I could say to him, I want you to come and work 1 to 2 days a week for the first 6 months. I'm going to see how you go, and then I'll offer you the full-time job in 6 months. He would just say, I'm going to work for the other mob, Yeah. But I've got the opportunity now to do that, and I've done it. And that's the thing. And then, so I've sort of used it as an opportunity as well for growth, But there's lots of things. Yeah, when I came in that day, there's lots of just overarching things I wrote down, like, simple things like I've got to surround myself with positive and sort of supportive people, because I'm a person that thrives off positivity, So I wouldn't perform. I know I'm going to have to be at my peak to get the business through this, and our family. There's a lot of people relying on me, so our staff. So I thought I'm not going to perform at my peak if I'm not surrounded by positivity. And that goes for, internal like business, but I'm talking external too, friends, family. The people around me that, as negative forces, I've avoided, because I don't want all people that are watching the news every day, filling my head full of, what they're seeing on Fox News or whatever it might be. I don't want to know about it, I just want to know, practical things, and be surrounded around that.
Which is really good insight, is to know your own personality and know what you personally need to actually sustain yourself and operate at a high-performing level, especially in terms when the business probably and the people around you need you the most, which is it's a really good, insightful thing to think about.
Yeah. So there was a few other things there, like goodwill. I knew was going to be a big thing. So that was one of the first thoughts out of my head. Is a lot of our competitors are going to be anxious. They're going to be, their debtors are going to be chasing them, ringing them, hassling the hell out of, hitting them with a stick, saying we need our money. You've got to pay 100% up front for your next orders. I knew that's exactly what they'd be doing. Mm-hmm. So we took a different approach. Like I got my business development team to turn into the accounts team, and they've been the one chasing the debtors. So more putting the arm around clients. We're not going to get the money anyway. If someone knows it's 100 grand, we're not going to get that bill in April. They're going to want to pay us off. So we're the ones who go to them and say, look, why don't we work together? We know everyone's going through this crisis. Why don't you want to pay us off? But in the future, we're going to need 50% up front, and put our arm around them, and do it as a more relationship building thing. So I think like goodwill with customers, with suppliers, the same thing. Like we're not beating all of our suppliers. Obviously do want cheaper prices, but we're working with them to get to that point. internally with our staff, goodwill, has been a huge thing. So I know that goodwill in 12 months or 24 months, people are going to remember the people that stood up, and that's what I want all of our business to be, remembered at the end of this.
And I think it's great that you've had that attitude, and we've spoken at length about that, and even with your team that you've still engaged us to do leadership workshops for them to help them stand up in the crisis as well, which it's an investment at this particular point in time, but it certainly, people remember that, and it'll pay off dividends for you in the future in terms of the goodwill as you talk about. So it's actually quite amazing to invest the way that you're investing right now in uncertain times.
Yeah, it's good you mentioned that. Like, it's business as usual. That was another thing as part of the plan, was it's business as usual as much as it can be. Like, we were in, like I said, the middle of a restructure, culture review. It was restructuring the sales department, doing new role descriptions for everyone, KPIs, like the whole works. And that has all still gone full steam ahead. We could have easily, particularly with the values, like, it's such an easy time to probably lose sight of your values. And maybe, like, I had an opportunity yesterday where a customer came to us and they wanted an invoice for something that we wouldn't normally invoice them for. We'd give it as free of charge for a product. Could have easily said, threw them off an invoice during this time, so they're expecting to pay for it. Yeah. But I wouldn't have done that 3 months ago, so there's no way I'm going to charge them now for it. And business as usual was the big thing. Like, keep our values, and now that's why they're there for these times.
Exactly.
So more than ever, they're important. Like, like you said, the leadership stuff with you that we've just done over the last 3 weeks with 8 leaders in the organisation, like, the feedback from that has been phenomenal. Like, I know you received some good feedback, but I've received that much feedback, and people, emails from every single person. Like, I applaud your persistence in going through this stuff. It's amazing what you've done. Like, I've got, again, just obviously on a practical level, it's great to have them motivated and having them skilled up for when the wheel turns, but just for them, that goodwill again, to see that we as an organisation are still investing in them.
But you've also been through some hard times too. You've had to let people go through this process as well. And that's been difficult for you as a business owner and as somebody who cares about your team.
Yeah, that was probably the hardest thing was, especially before the JobKeeper got announced, we had to make some really tough decisions because of the significant drop in revenue. And we have a high wage bill, obviously. So I had to do 30 calls on a Friday to, majority of people were at least cut down to part-time to 50%. And probably, a handful of people we had to either stand down or terminate as well. That was really difficult. And to give context, I suppose you'd say, I'm an emotional person, I'm positive, I get sad sometimes, all that, but I never cry. I don't know, my wife thinks I'm weird. I don't cry. And that day, I cried for the second time in my life,
What was the first time, Dave?
I
didn't know this story.
Actually, yeah, it was the Justin Timberlake Future Sex Love concert at Etihad Stadium in 2016. And I still, to this day, cannot work out why. I seriously cannot work out. I remember it was halfway through Rock Your Body, and I was standing up and I was dancing. And I started crying, and my wife just looked at me and was like, "What? Why are you crying?" And I'm like, still to this day, I do not know why I cried at that point. I cannot work it out.
So we fast forward. So it was emotional for you this time, right? Around what was the emotion that you sort of had to deal with, because it was so positive?
It was mixed emotion, because it was heartbreaking but heartwarming at the same time, because I had people where, one, for instance, who's on a bridging visa, a lady who'd only been working with us for 5 months, so she's still in her probation period. So I had to not continue her employment and not stand her down. She was in her probation period, and her husband had got laid off the day before. She's here with no family support whatsoever. They've been here from Dubai for 12 months. They've got a daughter, and then she was crying on the phone, begging me to stay. And I just couldn't do it. It was absolutely heartbreaking. And then on the other side, I had people who leaders, like a couple who work for me, who are getting married in December in India. They got huge student loans, rent a house. And when I told them that I need to put them down to part-time, they said to me they'll work for free if they have to. They said they'll work full-time still, do all the hours, and that's where I got really emotional, because just people stood up. And whilst it was really hard, the people that stood up and really supported me as well, that was really good to see, and showed, I suppose, all the investment we've made in this stuff, you know, the culture and the stuff you've helped me with, that's all a reflection of that.
That's awesome. Look, I mean, I really appreciate the honesty and the rawness of what you're speaking about today, because we're all going through this, and it is emotional for all of us, because our businesses are pretty much our lives to a large extent. And what you've just demonstrated is that, especially in a family business as well, how that sort of impacts upon, you know, another layer of complexity. Is there sort of a message that you wanted to sort of leave us with today that you haven't got across so far at all, Dave, in terms of...
The only one I'd probably say actually is a continuation of that, is that, you know, don't look at LinkedIn number one, because everyone's an expert on there, an entrepreneur and got no problems in the world, you know, and they're all doing great. So your competitors, I know another thing of anxiety is seeing what competitors are doing.
Yeah.
You know, rushing things to market. And the only thing I say is just take your time. You know, we're doing a series of webinars that we're about to start off in 2 weeks, CPD webinars, and like our competitors have rushed to market with them, but I've watched them and they're, you know, a lot of stuff's going on like that. Like people are getting anxious watching what the competitors are doing and trying to keep up. Keep, you know, stick to your plan, I think is a good thing. But touching on the sort of anxiety is that everyone's going to go through times like I did, you know, like even a week ago, where I didn't sleep on Sunday night, and Monday I felt like shit, you know, and I was, you know, I'm not all positive all the time, but I realised that when I've faced those times, I need to either be disciplined and get myself in a positive mindset. And if I can't, because that's just like, I'm not a robot, I've got to take time out. And whether that's to like a couple of hours, like I took the kids for a ride on Monday when I barely slept the night before, and I just defer any important decisions or any important conversations till either later on that evening or that night till I feel better again. Then I jump back on the horse. Because again, that's my mindset in a way that I thrive when I'm positive and probably perform my peak. So I know I'm not going to be positive all the time. Acknowledge that I'm human, and just make sure that you know, I work around it. I have something in place, a plan in place for it.
That's awesome, Dave. And look, you know, as I said, I got you to speak today just because I've been, you know, really inspired by, you know, what you've been doing in your organisation and the way you've gone about it. And you know, I think it's just good to be able to share those stories and knowledge for each other, because we all get knowledge and benefit from it. So thank you for your honesty and rawness. And you know, I think that no doubt everybody on the line today would appreciate the fact that we all learn stuff from people just by the way that they go about things. And I think it's been great. So thanks for sharing today.
Yeah,
and you know, obviously working with you is a pleasure and a joy from my point of view as well. So thank you for allowing us.
That's good to hear. Thanks very much. Thanks for having me.
No worries.
All right.
So I am going to, I know we've spent a bit of time today going through those 2 presentations, and we were going to talk about the stimulus, which we might give a couple of minutes just on that, because there was some legislation that was announced yesterday which clarified some of the alternative tests in relation to the 30% drop in your turnover. And so what we're going to do is probably just give about a couple of minutes on that with Paul Maneri, who you've heard from before, is one of our directors at Prime across the sort of the tax advisory space, and he's across this change. But there is complexity in it, and I think probably what's going to be better is if we've got a little bit of time to digest it and weave through some of the complexity of it, and put a note out, which we will do so. But Paul, maybe you can just spend just a couple of minutes introducing that, and then we'll go to some questions, and then we'll end it for today's session. But thanks, Paul, for doing that, because I know that it's only just been released yesterday in legislation form.
No problems, Matt. Yeah, as you mentioned, we can just touch on what we've sort of learnt over the last 24 hours. So we were eagerly awaiting some kind of clarification around what the alternative test would look like, considering that in a lot of examples for our clients, the basic test, which was a comparison with year-on-year turnover, didn't apply. So yesterday there was a legislative instrument released with an explanatory memorandum, basically just outlining what those tests are. And it's a way to sort of bring the comparison of revenue in the current period and reflect that in comparison to an alternative period that doesn't sort of relate to the previous year. So in summary, there's 7 categories that have been identified. and we'll just run through those briefly. Each has its own sort of comparative period that does apply, and we can outline those, as Matt said, in some correspondence to come. But just in brief, we've got the first category, and one that's relevant for our client base, is in relation to businesses that weren't in existence 12 months ago, so startups effectively. The second category is businesses that acquired or disposed during the year, and that had an impact on its turnover. A business that restructured, and that restructure changed the entity's turnover. If there was a substantial increase in turnover, so it might be a business that was just in basic growth phase. There's requirements around that, around what that growth needs to be in order to satisfy the subsequent drop in revenue. So effectively it amounts to an annual turnover increase of 50%, compared to the year before. But there's specifics around that each client example will need to sort of work through. Point number 5, businesses affected by drought or natural disaster. 6 is where a business has a regular turnover, but it doesn't include seasonality, because over a 12-month period, seasonality should even out. So it's probably just more specific examples where the turnover, for whatever reason, doesn't sort of have a regular pattern. And point number 7 is, and this is limited to sole traders and small partnerships, where the key individual has sickness or injury or leave in the earlier period, and therefore that sort of comparison doesn't apply. So interestingly, this point doesn't relate to small companies that are effectively self-run by a single director. So it's limited to sole traders or small partnerships in this example. So I guess that's where we sort of stand, is sort of deciphering what these tests mean and effectively, but it does give us some guidance on how we can apply different tests where the basic test doesn't apply. So that was the important sort of announcement that came through yesterday. So the only other thing worth touching on is, as something that's come through in the past 7 days, is the eligibility or the availability to enrol in the program, which can be done via the tax agent portal or the business portal. That process we've worked through with some of our clients is fairly straightforward. However, one of the components of that requires the business to effectively select the date in which the drop in turnover applies, and so that's where some work might be required to, especially if we're looking on a forecast basis, to see that does apply.
Thanks, Paul. I mean, obviously, we get lots of things coming through week to week at the moment, and we're hearing them as you're hearing them. So we don't get sort of the benefit of digesting them before we have to then go and present on this particular topic. So that's why it's sort of come out yesterday. We'll get a note out to everybody today as part of just our natural communication around this particular stuff. But obviously reach out to us too if you need sort of clarity around those things, because obviously we want to try and ensure that everybody gets, the benefits that they deserve in terms of these the government stimulus.